Hello, welcome to your October 4Thought. I'm Nathan. This is Lauren. Last time you saw us, we were in a different venue drinking some pumpkin flavored coffees.
Yeah, much sunnier day.
Much sunnier day.
All the seasons have changed because we're in the season of gray.
Yeah, it was still summertime, and pumpkin flavors were everywhere. I was contemplating if it was a little too soon for that. You see pumpkin everywhere, earlier and earlier. It's in my coffee. It's in my beer.
That's right.
It's everywhere. I don't mind it per se, but I feel like maybe it was a little too soon. Now I can't see the sun.
Yeah.
I can see colors in the trees,
That's right.
which
That's
is
the
nice.
good part.
I love fall.
That's what the gray sky does, is it highlights the colors of the season.
Yeah,
So
it's working.
speaking of fall,
Yeah, something else has you may have noticed has been began to fall, which is interest rates. And we wrote in the newsletter just a little bit, just generally speaking, how interest rates are coming down. And I think it's important to note. I mean, it's a big change in policy from what we've seen the last 2 or 3 years. So we wanted to maybe use this time to talk a little bit more about that because it affects a lot of things, not just your portfolio.
yeah. I mean, because we say it all the time, we don't like to do a video on the exact same topic that we wrote about. But like Nathan kind of communicated, we want to add a little color. See what I did
Sure,
there?
that was good. I liked it.
To that, because it's such a big change, and we think the trajectory is going to continue. So we want to make sure that we're getting into details. So I guess I would ask Nathan, how did we get here in the first place?
Oh, sure. Yeah. So I think it's a good thing to do is just to look back and say, okay, how did interest rates get up to this point? So I think all of us remember what occurred in 2020, and as a result of essentially the economy shutting down, and then the Federal Reserve stepped in and said, hey, we're gonna take aggressive action.
That's right.
To increase liquidity. And one of the things they did was dramatically lowering interest rates and making cash available in a myriad of ways. And so that action, kept us out of recession. 2020 actually
but there was a downside.
It was a wild year, but the market was actually up.
Yep.
But the downside, as Lauren is alluding to, is inflation. So inflation spiked and went 7.5, something like that at the highest point. Maybe.
Yeah, depending if you were buying I bonds, you were able to lock
sure.
in rates at over 9%.
That's true.
So it was, again, yet another unprecedented time in our economy. And I guess what we could say is the Fed kind of lowered interest rates. That kind of generated some positive activity, also generated some negative activity. Mm-hmm. And then what did they have to do after they did that?
Right. So they're taking out inflation. They're squashing inflation. That's everything we've heard from them for a couple of years now. And they have a dual mandate though, right? So that's one side is making sure inflation isn't out of control, and they want to get it back down to their target of 2%. And the other side of their dual mandate is employment, right? So if they start to see any weakening there, if they start to see, hey, the economy still looks strong, but we don't want to see a weakening side, are we okay on the inflation side? Has it gotten back to the point where we can kind of let off the brake pedal? Because when they're raising rates, they're essentially slowing down the economy.
Yeah, and I think they were raising rates just as aggressively as they were lowering them. Mm-hmm. And so far, so good. Just like you identified, the target's 2%. Mm-hmm. And you and I were talking earlier that it's trending about 2.4. So maybe now the focus is shifting to employment.
Right. So now they're going to focus on employment. And so them coming out and reducing rates by 0.5, 50 basis points. If you want to sound smart, you can say basis points, 0.5%.
Yep.
And typically, historically, we don't know what the Fed's going to do. They're data dependent. They're going to say that every time. Every time he stands at the podium, I can probably count the time he says, data dependent.
Yeah.
And you could put a game together.
That's right. Some kind of game.
But historically speaking, when the Fed has obviously moved so aggressively on one end of the interest rate side, which is raising rates so quickly and so aggressively, when they start to reduce rates, they don't usually just do it once or twice. They usually set the path for some reduction in rates over a period of time.
Yeah, you often hear the catchphrase that they take the steps up and the elevator down.
That's true. Yeah.
So
that too.
Hopefully you didn't invest a lot of time into watching the most recent press conference like Nathan and I did.
Okay, that's what we do.
We kind of do it for you, and I think there were some great takeaways from that. Some really good questions. love Jerome Powell or hate Jerome Powell. I think his communication is as transparent as it can get from the Fed.
As good as we've seen.
As good as we've seen. So, he really emphasized that 0.5% cut, what was a commitment to just what we were talking about earlier, making sure there's liquidity in the economy so that companies and individuals have a little bit lower rate to borrow from, and that's going to help with spending. So I would say, at least from my perspective, if you're thinking about making a big purchase, or if you have some high interest rate debt that maybe you accumulated over the past couple years.
High interest rate debt. What about a mortgage debt? If you bought a house in the last 2 years.
That's right.
And you maybe said, hey, we're going to do this knowing that, or at least anticipating rates would be lower in the future, and you might get an opportunity
Your
to refinance
prediction
that
looks
debt.
like it's coming true.
Maybe you have now some opportunity in the next 12 months or so to take action.
Absolutely. So again, debt reduction, I always want to say this because sometimes I don't hear this enough. Hopefully everybody knows that if you have a 3% mortgage rate and you want to tap into some of that equity from your home value popping up, you can take a home equity loan, doesn't disrupt your 3% interest rate on your mortgage, and maybe tap into some of that equity in your home to do whatever you need to do. Big purchase, refinance,
whatever.
all those things.
Yep.
Now, I think it's also going to have some effect on people's portfolios, and always there's good and bad to it, but of course we like to have it a little bit sunnier since it's so great today. So I'll let Nathan handle that part too.
So I'll say, let's take it from this perspective. That there's a direct correlation with a part of your portfolio. Then there's maybe more an indirect correlation, right? So there's a more direct correlation as to your fixed income or your bond side of your portfolio. So as interest rates come down, your bond values go up. It's kind of like a seesaw, right?
Yeah, they call it an inverse relationship.
Right. Thank you for that.
Welcome. Yeah, I'm working on that all day. Finally got to use it.
So as rates are coming down, you'll see the bond side of your portfolio, the prices that you see reflected in your statements will firm up. That's already been occurring for several months now, and that looks like it's going to continue. And for the last 2 or 3 years, bonds have had a horrible run.
Sure. In an interest, just like we talked about, interest rates were going up.
Yes.
And that negatively impacts bonds. So you hold a balloon underwater long enough, and then it's going to pop, and that's what we've seen recently.
Right. So depending on what your objectives are, obviously for folks that we work with who need income, you have to make sure that the fixed income portion of your portfolio is still going to provide that, or you're going to have to look at other things. So we want to be looking at that. Obviously, for those who are using it as a diversifier tool and just kind of a piece of your portfolio, it's going to look a lot rosier. That the picture for fixed income now and into the the not too distant future looks pretty good.
Yeah.
Now that's more direct correlation.
And then I'm going to interrupt like
Sure.
I always do, because before we get away from fixed income, I do want to talk about this because a lot of clients, and then probably people that you're friends with or you work with, have high interest savings accounts, right? HYSAs. And if people were depending upon those for income, that's going to be at risk now, because those interest rates dropping, like Nathan said, there's an inverse correlation to bonds. There's a direct correlation to the interest rates that you have in money markets.
Sure.
As the Fed lowers those are going to drop.
And we've already started to see that happen, right? They happen they happen real quickly. Not as quick on the way up, but they sure do. They sure do come down as soon as the Fed takes action. So
yeah,
we'll start to continue to see that.
Great. So same thing that we always say. If you we do these videos so that you can kind of have some interaction with us on a broader scale. But if you want to drill down into your personal circumstance, please contact us. Because what we would say is you want to start extending out that duration. If you need cash in the short term, you need cash in the short term.
Sure.
But if you're holding some of that for a little bit longer term, now would be the time to have some conversations about what to do to maintain that interest rate that you have now into the next couple of years.
And I'm glad you interrupted. For once, that was great.
That's it.
No, I like all the times you interrupt. But so because we have a lot of clients with money market and high yield savings accounts, and we speak to a lot of people who have accumulated a lot there, and it's been honestly that's been great. Getting 5% for
5+,
essentially no risk. You're in a government money market fund, most likely, or at a bank. So it's been great, but things change and evolve, and we just want to make sure you're aware of that. And then as that landscape changes, there'll be other opportunities for you.
Yes.
So now, do we want to talk about just more indirectly how lower interest rates affect first, maybe if you want to say the economy, and then maybe, stocks in general?
Yeah, I'll do my best on this. And again, we're talking about general trends. It doesn't mean that this is a prediction for the future because nobody can do that. Anybody that's telling you they know what's going to happen tomorrow, other than the market's going to change,
Yeah.
isn't an accurate predictor of anything. But just like we were mentioning, hey, there's less attractive options in fixed income because those are going down. Money markets are dropping rates. CDs are going to be dropping rates. Government bonds are going to be dropping rates. You may actually see a little bit of an increase in the value that high dividend paying stocks provide.
Yeah.
So that could be one area of the marketplace that you could see some additional attractive opportunities due to the yield. And again, because smaller companies have a different balance sheet than larger companies, they depend more on borrowing for their day-to-day activities and their needs, and they have to finance equipment or hire people. So as borrowing costs come down for them, you actually see a little bit of increase in the growth.
Mm-hmm.
So high dividend paying stocks and small caps traditionally have a little bit of a boost after you see a Fed interest rate cut. Now, on the economy as a whole, even though I majored in economics, it was so long ago, I don't know if that counts. I'll let Nathan handle that final part.
Well, I just think, just as we started this video discussing what the Fed did to get us to this point and getting inflation back down to close to their 2% target, and they feel comfortable enough to let their foot off the brake pedal. Their foot is on the brake pedal, slowing down the economy. How they're slowing things down is raising rates. So if that's true, the opposite is true. Typically, when you have reduced rates, it helps the overall economy because, number one, we're driven on, borrowing and debt.
That's it. We're a debt-based economy. We love to spend, and that just helps spending as you have more liquidity in the marketplace.
Yeah, absolutely. So, when we look at things, and we're never going to be predictors, as Lauren said before, we're not going to predict what's going to happen in the short term. But
Correct.
What could happen next week, next month, next quarter, who knows? But typically, when you're entering an interest rate cycle that's now going the other direction, that's now coming in, it's reducing rates. That's typically, that backdrop is pretty good for the economy. And they typically haven't entered a rate reduction period at a time in the market that's been good. So you also have stock market that looks pretty healthy. You have economy that looks pretty healthy, and now you're going to start reducing rates. We'll see how far they go. We don't know, but certainly it does seem like they're opening the door for further rate cuts into the rest of this year and into next year.
Yeah, I think that's a great synopsis, and hopefully we've said this time and time again. Please reach out to us if you want to have more specific conversations about your unique circumstance and how these things could affect you. And if you're planning for some of those things that we talked about, retirement or a big purchase in the future, or anything else related, feel free to contact us in any way possible. We can help you. And then same, friends or family that may be going through something and they're turning to you for advice. So thanks so much for all the time you give us every month. And of course, all the time you give us in all of our conversations that we have day to day with you. We look forward to the next conversation.
Well said. Thank you.